All right, so welcome to the March 18th session. Hope everybody is staying safe wherever they are. A lot has happened since last week, not only with the virus, but also with the economy, and obviously some unprecedented things, which kind of makes the EIC analysis both challenging and very real to what's happening in the real world. So as we get started today, like I said, today's focus is going to be on EIC, which stands for Economy, Industry, Company. And we're going to kind of review the homework assignment and get a sense for what is going out there. And then we'll talk a little bit about week 3 coming up at the end of the session. And then also just today, we're going to select teams. So again, you can pick a publicly traded company, and then your team can actually value that company. Now, I forgot what section. I got an email from one of the teams said they wanted Netflix. So I think that should be fine. But if anybody else wants to pick companies, you can kind of talk amongst yourselves in the chat room, and we'll validate the teams that you guys are going to work on for the semester-long project. So I'm going to go ahead and share my screen here. Share the desktop, make it easy. And so on my screen, I'd put up a lecture note that we're going to cover today, but also in the People tab, these are currently the teams. And again, we have 2 people who are, as of right now, not in teams. So is Michael or William happen to be on this call? No Michael, no William. Okay. Well, in that case, we have 3 groups. Matter of fact, while we're here, does anybody from group 1, 2, or 3 want to tell me the company that they'd like to do as their project? We can go ahead and assign those now. So while we're on the screen, turn the TV on. So anybody from group 1 here? Have you guys talked?
Yeah, we haven't talked about it yet, so don't have an answer for you.
All right. Talk in the chat room. Has group 2 decided?
We haven't talked yet either, so we'll have to discuss.
Like I said, so let's multitask while the session's going on. Chat amongst yourselves. So again, I'm not giving too much in the way of restrictions. Basically, publicly traded company can't be one that we're working on this semester or really kind of focusing on as one of our assignments. But other than that, you can basically pick a company that's in the news. And again, obviously, I'd pick one that is of interest to you based on what is going on, either in the good sense, or the bad sense. If you want to, kind of tougher, it might be like what's happening to the poor airlines versus, actually Walmart's been holding up relatively well, given all of the challenges, probably for more obvious reasons. So we'll come back to that a little bit later. All right. So let's talk about EIC and the assignment for EIC for this week. So I'll come over here and talk about the EIC analysis. So, is it? Okay. It is. All right. So this week we focused on Nike, and before we kind of talk about the Nike assignment, we're going to talk about the E in the EIC. And so just to remind us from the video, and to some degree, I gave the lecture notes in the video if you wanted that as reference. The point of EIC, as I said, is it's one of the 4 frameworks that we are going to talk about this semester for valuation, kind of a piece of the puzzle. And the first piece basically says, we talked about last week, approximately half the performance of the company is going to be in the industry or the environment that it's in. So there's 2 pieces to EIC. What's the environment today, and how does that explain the performance of the company? And more importantly, how could that environment change over time, and how will the company react as the environment changes? That's really what we're trying to understand. And it's just an important precursor, because before we get to the math and start putting numbers into spreadsheets, I think we need context for the math, because essentially the EIC should inform both the assumptions we make and to some degree the scenarios that we would create, right? So I gave you some data from Bloomberg on the economy, but let's start out with what's going on in the economy. What did you guys, say, find out, think? And as I said, this data seems to be changing in real time. So any thoughts on the economy? You want to jump in and share their thoughts? You just unmute yourself and jump right in.
I mean, just overall, it seems that I think I looked at it the factor of like the forces that affect GDP specifically for Nike. Consumer spending probably going to go down. Domestically, I didn't really look at it internationally, but I don't know. It's really hard to like figure out what's going on right now in general. It seems that
let's take a more macro view. In fact, you could even do a Google search. So what is US GDP 2019? And so right now we're at about $21.4 trillion as an economy, right? And so this is what we're trying to understand. Like what's the economy going to look like? And how is it going to start to evolve? And by the way, I'll go beyond the Nike assignment. Like what are you hearing in the news about GDP? And I'll put this in perspective. Like today, Congress is talking about with the Democrats or Republicans, basically putting approximately $1 trillion stimulus on top of the $800 billion stimulus. Well, if you think about this, $21.5 trillion divided by 12 is somewhere around, call it 1.7, $1.8 trillion a month, averaging it out through the year. So, I mean, that's the size of the economy. And right now, unfortunately, because of the virus, next 2 months, you're going to see people aren't going to spend 1.7 trillion a month. So, what are the economists saying? And if you've been kind of listening, I actually found an interesting article, which I posted on LinkedIn, that said in February and March of this year, when China was doing what China was doing, their GDP plummeted 20%. And that's actually what they're starting to talk about in the US. So if you actually look at, people are no longer saying we're not going into recession. So it's just a question of how bad is the recession. But what they're really saying is we could easily see a decline of 5-10% in GDP. We could see unemployment spike quickly above 10%. Obviously a lot of bad things could happen. So anybody else see some headline stories you want to share about this? Or thoughts? And by the way, just to give you some supporting documentation on this, here's the data from Goldman Sachs that they've been rifling around Wall Street, which is Goldman is expecting first quarter GDP to shrink 5%, and then, shrink 5% in the second quarter, and it could get even worse after that. I mean, unfortunately, nobody knows. But that's what the stimulus is for, but the economy is being crushed. I think there's an article today about JetBlue saw their bookings plummet 80%, plus they're now giving refunds since nobody wants to travel. So again, in the context of just what's happening in the real world or with Nike, how bad is this going to get? And what does this mean for an industry like athleisure, particularly retail? How would we assess this? or how did you assess this?
Well, the market cap had a weighted raw beta of 0.95 for the industry. So if the economy is collapsing, Nike's going to go down pretty much just under a 1-to-1 ratio with that.
All right, so let's start out with the beta. And I gave you, I believe, this screen. So whoever just answered that beta question, I'm sorry, this is just a lot of videos that are popping up. Can you explain from the video what we're looking at on the screen and what matters?
So under market cap weighted average, it says raw beta of 1.1. I think that's different than what the screenshot had, but regardless.
Yeah, I just did it in real time, but yeah, 1.1.
Okay. So if the economy is going down significantly, which it is, then Nike's stock should go down just as quickly with the market.
Well, if we use market cap weighted average, that's the average of the peer group.
Or sorry, Nike's is 1.05. Yeah.
Yeah. So, the proxy we're using here, and just if anybody has any questions about this, is basically what I would like to call a transitive property, right? Which is if the market is going to be influenced by what's happening with the general economy, then the question is, how are companies tied to the general market? And so the whole idea of beta is it's talking about, is it kind of like tied to the market? So beta of 1 is you're going up and down with the market. Therefore, we're saying by proxy, you have an average sort of an economic level of risk. And if your beta is 1.1 or 1.05, that means you're going up 1.1%. When everybody goes up 1%, you're going down 1%. Market goes down 1%, you go down 1.1%. So you're going up faster, you're going down a little faster. So this industry historically is probably more sensitive to economic changes. But I want to go beyond the numbers. And what I mean by that is just think about what's happening in the world today. Do you think that this is really reflective of how bad it's going to be for a company like Nike? And why might it be worse for Nike than this beta represents?
So I think it's going to be worse for Nike. Just we basically canceled all sporting events of every kind for the foreseeable future. That's, I think, a huge marketing. It's a huge marketing hit for them. It's they've closed malls and shopping and all kinds of stuff. I think it's going to hit them a little bit harder than it's going to hit a lot of people, just because they don't have any way to advertise right now.
So I think that's actually relevant to this conversation. So for Nike, you're actually seeing a hit because it's going to affect the fact that, as you said, they're losing some of their halo, which will affect sales. What else could be very bad for Nike? And I'll give you, there's a summary of Nike headlines, but there's something else that I read about Nike this week that I think is very relevant.
But I kind of feel that since Nike's most products are coming from China, then that's a big thing for them. They've lost already, and they're going to continue losing because everything is kind of shut down in China right now.
And it's no longer just China. I mean, it's now
true.
I changed throughout the world, but in Asia in general, it's getting tougher outside of China. And I think they were also doing some manufacturing in Vietnam and other places, but that's absolutely going to hurt Nike as well. But I'm thinking something even more practical about what's happening to their retail stores in the United States. What did Nike say about their stores?
Was it something to do with the tariffs? The tariff that has been imposed?
I was thinking even more practical, which is they're shutting down all their retail stores. Like Nike announced they're closing all their stores for the next 30 days. So that's the other thing, which is they're going to take a retail hit because you can't go to a Nike store right now. Even if you wanted to go to a Nike store, you're probably not going to go there because of all the things that are happening. You know, all the things that would make you want to buy Nike in general, as somebody pointed out, sports events, etc. Right now, that's not people's priorities. And then the other thing is supply chain problems, which makes it even harder for them to manufacture and get the shoes. So, you know, this is when we go through the entire EIC, you know, this is really what Wall Street today is trying to figure out. And we are in uncharted territory here. I mean, there is no, comp that we can really use to say whether it's Nike or anybody else about what this really means. So obviously there's a longer term view, which is, I think, it's a little bit more sensitive to the economy, right? And generally, in a good economy, Nike does well, bad economy, less well. But in the short term, they're probably going to take an asymmetrical hit because retail in general, I mean, there's another article I read this week, which I think is a good example of explaining the US economy as a perpetual motion machine. Because when I spend, I'm basically funding somebody else's income so that they can spend. And right now that's what's shutting down, because if people don't spend, then the people that they're not spending from don't have any money, and it just is cascading through the system. And so right now, Nike is a retail market. Nobody's buying things. Nobody's, you're sheltering in place in California. It's about to be New York. Matter of fact, the scary words that were on Gavin Newsom today, who's the governor of California, is he started using the word martial law, which is first time that's been used in this crisis. But the state of California is talking about martial law. It came up as a question: are you going to martial law? I said, not yet. But that's the type of things that would not be good for the retail environment. Anyhow, so in the context of the homework assignment, I think what we could say was said based on the original data is industry beta 1.1, company beta 1.05. We definitely need to care about the economy. Okay. So the other point is, in today's market, probably need to care about it a little bit more. And so how bad is it going to be? This is where we need to start thinking in terms of almost like scenarios. And generally, there's the worst case scenario and there's the not worst case scenario. But even if we're looking at, 2 months of, shutting down versus 6 months or 12 months or 18 months of shutting down, that's going to be a question, is what happens to Nike during that time? And more importantly, when we recover, will this go back to normal? And I don't know the answers to those, but that's something that we would have to consider as we do an EIC. So let's break out those two questions. What do you guys think about the first question? How long do you think this doldrum is going to likely last?
Three months.
Okay. Is that the kind of the vision of the class, 90 days?
Yeah.
CDC is saying 2 months, right?
Okay. So in the context of 3 months, let's talk a scenario. So what happens to Nike in the 3 months, and then what happens to Nike, after 6 months, longer term? What would you say? Whoever said 3 months.
I think that eventually Nike gets back to open stores and moving products, but they're never going to make up an entire quarter's worth of lost business. And I think, to the point somebody made earlier, all of those sporting events where they had opportunities to promote new products and stuff are potentially lost and not happening this year. I think there's a lot of lost opportunity for Nike that they're really not going to make up for. They can try to catch up, but to what effect they can pull that off, I don't know.
So as I said, we have it, again, play out scenario. Scenario is 3 bad months, and we can call that one time. And then the answer is, then we get back to some level of normalcy, and then we kind of go back to where the betas are now. The economy gets better, and Nike's kind of okay long term. Or these 3 months really do change the world for a long period of time. And it's not just 3 months. Even if the virus passes very quickly, people's spending habits, whatever, are dragged out for a longer period of time. That could potentially change. And I'll give you 2 other examples that are happening in real time. So number one is, in the medical profession, they've been talking for the last 10 years about telehealth and telemedicine. And everybody's been talking about it, and the regulations have been hard and poo-pooing. In the last week, it's completely flipped. Matter of fact, even just very practically, I'm supposed to see my doctor. My doctor basically said, don't come in. We're going to do a video call. And I said, can you do that? And they're like, yeah, 100% covered by the insurance. So even in the last week, the whole outlook on what we're spending on. Matter of fact, back to Amazon, Jeff Bezos just said, I'm hiring 100,000 new people because of all the people that are going to be buying stuff through mail order. Is that going to fundamentally change our relationship with the retail market going forward? Because right now, Nike doesn't sell a lot through Amazon. If we get used to buying online, is that going to change things when we get out of this recession? Because now we get even more into the Amazon society than we have been in the past. I mean, these are questions, and again, I don't know the answers, but these are things that are eventually going to be the types of things we got to think about with Nike as we think about the EIC. So what made your assignment, in my opinion, more interesting is this is exactly what Wall Street's trying to figure out today. And so the only way we can start thinking about it is scenarios. So scenario one, 90 days. Scenario two, 18 months before that we're dealing with this, and it's longer term. That's probably booking ending the scenarios. And so, what happens after that, given those two bookends, we can start thinking that through. But for purposes of the assignment, just to keep it a little more simple, you could have said the beta was the 1.1, the 1.05. That it's a little bit more sensitive. And given the economic data that I gave you, you would expect that Nike's going to take a hit. Like, as far as the assignment goes, that's generally what I was looking for the E section of the EIC, right? And again, just since we were talking about a couple things in the economy since last week, one of the things you might find interesting is even since last week, this is the borrowing cost for Nike, but I'm going to put the curve up here for today's yield curve for interest rates. Kill this Treasury curve on and kill the Nike curve. And here's what's interesting. Since the last time we were on the phone, this is what's actually happened to the yield curve. And so this was last week, and this is today. What does this tell us about the economy? The yield curve is not really inverted now. It's going back to a more natural curve.
Doesn't that mean that the expectation is that money will be worth that much more in 9, 15, 20 years? Like, expectations are the economy will recover?
Yeah, we are getting more of a traditional yield curve, that the economy will recover longer term. And by the way, people are putting all their money into cash short term, because that's the other thing that's happening. Is they're just selling everything in the panic, and they're just putting it literally in cash. They're not putting in long-term cash. They're putting it in short-term cash. And you can actually see that interest rates on long-term stuff is actually rising in the panic as opposed to falling in the panic. It's the short-term interest rates that are falling. So I'm not saying the market's right, but if you look at this and you think about the wisdom of the crowd, it's basically saying next few months, awful. Long-term, return to normalcy. That's the way they're starting to think about companies, right? Matter of fact, you actually had a couple people today on CNBC, it's had play in the background, who basically said, now's a great time to buy some of these stocks. You're going to be very happy in a couple of years. One of the things we might figure out this semester is Nike one of those, right? But that's Nike. That's kind of the industry that we're in. Tough market, but long-term, still sensitive to the economy. Short-term, they're going to take a hit. Question is, can we quantify, if we did the valuation, how much would that be? But obviously, the economy matters. Second part of EIC in your assignment is the industry. And the key to the industry is we start out with list of companies that I gave you, which was their athleisure peers. And we wanted to look at their spread. Spread here. All right, so is this an attractive industry? What numbers did we use? And we'll answer the question on the screen, does Nike have competitive advantage, and what numbers would we use?
Say yes, this is an attractive industry because the has a positive spread. So the market weighted cap average for ROIC of 25.7 is greater than 10.97, and the operating ROIC, so on their operating assets, of 37.7 is greater than the WACC of 10.97.
So again, for purposes of this class, which one should we be using?
Operating ROIC.
Great. Watch the video. Why?
Because that's the return that the company is making on its operating assets. So anything related to its core business.
Yeah. So you're right in both senses, like Nike's industry. So let's talk industry. This is an attractive industry on both counts, like on an operating basis, and when you throw the non-operating stuff in on a non-operating basis, it's also an attractive industry. Okay. But when we do the analysis of the five forces is not in the non-operating stuff. The analysis of the five forces is on the athleisure part. They're selling shoes, they're selling shirts, they're selling sportswear. That's the operating stuff, and that's what our five forces analysis is really trying to get to. So why are they making almost 38% as an industry? And here's the next question. Does Nike have competitive advantage? When we get to the C section. Given this data, does Nike demonstrate competitive advantage?
Yes. Yep.
Because
because the spread is higher than the market spread.
Yeah, 41. You got to use numbers. 41.32 against 10.02 is more than 37.78 minus 10.97. Okay. By the way, is Adidas creating value?
Yes.
Look at this data. Is Adidas creating value?
Yes.
Does Adidas demonstrate competitive advantage?
Yes.
Depends which competitors you're looking at.
This is the list.
Against Nike, no, but against the other.
This industry group, does Adidas have a competitive advantage? Yes or no?
No, it does not.
Yes. No.
It's actually the answer for this class is no. And the reason why is because the average spread in this industry is 37 minus 11. We'll call that 26 points. Adidas, which is a 28% ROIC, is nothing to sneeze at, is making 28 minus 13, which is 15 points. So even though they're creating value, even though they have a very healthy spread, it's less than the industry peers. So again, I'll use common language. Adidas is doing well because they're in a great industry. Adidas is not necessarily doing well because they're better than their peers in this great industry. So you can create value without having a competitive advantage because you're in a very attractive industry. That's Adidas, right? I'm not saying that if you work for Adidas, you don't think you're the best in the world at what you do, right? And that's what people in the strategy and marketing world will always do. But I'm saying from a financial standpoint, the definition we're using in this class, if you want credit on your assignments, spread relative to peers. You have to be able to outperform your peers. That's how you get competitive advantage. If you're not outperforming your peers, you don't have competitive advantage. That is a separate conversation than value creation. What about Under Armour?
No.
Not only do they not have competitive advantage, is Under Armour creating value?
No.
Right now, they are not. Okay. And that's the way I want you to start thinking about the data. All right. So five forces. Why? Why is this such an attractive industry? So when you talk about five forces, it's not just about Nike. It's about all the companies in this list, what I would generally call athleisure. All right. So why is this industry making a 38% ROIC in the context of five forces? Right. Now, remember, the forces don't necessarily have to be equal weight. So it's not like 20%, 20%, 20%, 20%. Some forces could matter more than others, right? But, and I'll make one other context, is that remember, when you do 5 forces, you're explaining the data. And so this data says this is a very attractive industry. So something about those forces has to explain that. So we do it based on our data, not based on our bias. So why is it an attractive industry? What did you guys say in the assignment? Yeah, buyer power, supplier power, barriers to entry and exit, rivalry. What's the 5th one? Substitutes. Why is this an attractive industry? What about those forces makes this an attractive industry? What did you guys say?
I said, I guess just go down the list. The buyer power was low simply because they're like unconcentrated and their size relative to the actual firms in the industry is small. So they don't really have any power. The switching costs are low. Like nothing stops me from buying Nike shoes one week and then going and buy it. There's no stickiness, right?
I
So
want to stop you there. If the switching costs are very low, that should actually hurt the spread.
yeah, but I guess I was looking at it in the sense of like, yeah, I guess that probably contradicts what I was saying, but I think the buyer size, the individual, in the retail industry relative to the size of these companies probably outweighs any of the other factors there.
Well, look at the companies on this list. I mean, if you look at sort of these national and global brands, there's not that many of them. And so in a way, it's almost like an oligopoly.
Right.
And so I think that's what you're trying to say. And I think that's probably more of explaining the negative spread. Like there's not as much competition as you think there is. And you don't have as much choices out there if you really want athleisure or athletic shoes, if you want to stay with one of the big brands. And so therefore the buyers, even though there's a lot of buyers, we don't have as much choice as we think, and that benefits the industry. So the dynamic is allowing the buyers to not have power. So I'd say I would agree buyer power seems to be low right now. We're not exercising it. Why else might this industry have such a high spread? What other forces are favorable?
So I thought that the barriers to entry is quite high.
Okay, why? I agree with you, but why?
Because of one is there is a brand image associated with athleisure, and the customers are usually brand loyal. And then I also thought that the capital cost to enter into this industry is quite high for the research and development, for the technology that goes into making the shoes or whatever, the fabrics and all that. And also the marketing cost and the manufacturing cost. I thought generally there is a high capital requirement.
Absolutely. I think there's one more that's along those lines. What else helps that with the barriers that you're talking about? What's another barrier?
I thought that the distribution channel might also come into play for this, because I thought that all the established players would already be monopolizing the distribution channel, so it might be really difficult for a new entrant to get into it.
Getting your shoe into a Foot Locker, into a Walmart, whatever, isn't as easy as you think it is on a national scale. They control the space. And so for the breaking into that can be very hard to do. Okay. Plus, I think another barrier to entry, just to go a little step further, well, we're not going to have a race, but what's happening with Nike shoes and marathons?
You talking about the 2-hour marathon?
Yeah. Well,
they
broke the 2 hours, but yeah.
Well, I think they were saying something about their shoes were giving runners a mechanical advantage, and they were cheating, almost.
Well, that's a question about whether or not you consider that cheating, but that was the point. That runners that were wearing these Nike shoes were not only winning, but they were winning at world record rates. And so people were saying there's differentiation in their product. So it goes back to, this industry isn't just about style, and it isn't just about slapping things together and throwing them out on a website and trying to sell them. And so that level of spend, and they keep upping the bar. And that creates barriers to entry, by the way.
Would that help or hurt Nike? As far as, yeah, maybe their shoes are giving athletes a competitive advantage, but if marathons and races start outlawing those shoes because they want to even the playing field, does that help or hurt them?
Well, here's the point. I think that there's a halo effect that, and I'll use the NBA as a better proxy, that I think there's a reason why people buy Air Jordans that aren't that very good at basketball. You know, that there is that halo effect that, hey, you know, I may not be the greatest athlete, but having a pair of LeBron shoes is something cool, and that's what I want to do. So there is some of that factor. And I think that goes back to that brand. And here's the next thing, which is, let's say you play at the University of Maryland. You actually play one of the sports in college. Do you have a choice about what you wear?
No.
You just wear any shoe?
No.
So that's the other thing. They've cut deals with a lot of sports teams and basically said, you know, we're going to be the exclusive whatever. I mean, it's not just Nike. So, for example, at Van Munching Hall, they're not allowed. We're actually scolded constantly to have Coke products. So every time you bring in a Coke product as a faculty member, they're like, why are you bringing a Coke product to Van Munching Hall? We have an exclusive deal with Pepsi, and they get pissed off. Same idea. So all these companies are making it harder because they sign these exclusive deals with sports teams. And whether or not they're paying the athletes or paying the teams, it actually benefits them. So barriers to entry are actually higher than we think. What else tends to give this industry, shoes, athleisure in general, a little bit better return generally? Got three other forces. We got buyer power seems relatively low. We got barriers to entry seem fairly high, nationally, globally. What else is favorable?
The bargaining power of suppliers is very low as well, just because the Nike itself, or in the industry in general, is spread throughout the world. They have factories everywhere, and so they use local suppliers to provide their materials, and so they can always switch off suppliers if they don't get favorable pricing.
Absolutely. So that tends to help them as well. So we got three forces in their favor. We got two left. Rivalry and substitutes.
So
Working for or against them. Yeah.
So I did not think that rivalry particularly helps this cause, because I thought that at least within the industry there is a great amount of rivalry. Probably it is one of those forces that is against the that does not explain why this industry is doing so well.
Well, I'm gonna say yes and. So I actually agree with you that there's relatively high rivalry amongst the players. However, in the more traditional five forces, I don't think the rivalry hurts the industry. I think the rivalry helps the industry for the following reason. Does this industry compete on price?
Actually, I thought no. I thought that it competes more on the technology and the brand image and all that. Therefore,
it's a friendlier form of rivalry. I'm not saying there's not rivalry. What I'm saying is this isn't the price war. This isn't I'm going to lower the price as low as possible and fight you to death to find the cheapest shoe. No one's doing that. Not of these players. You know, you're not seeing Lululemon who's saying, I'm going to give you $5 yoga pants, right? These are things that are all relatively expensive. And when they compete with each other, they don't come in with something that's the true generic. They come in with something that's going to be a better quality item or this or that, or Under Armour better fabric. They're not competing on price in general. And so I think that the rivalry actually is a little less intense because it's not price-driven rivalry right now. That could change. So there's rivalry. It's not hurting as much. Substitutes. What can we say about substitutes for this industry?
I thought it depends, because if you're looking at athleisure and the leisure part of it, it could be probably substituted with casual fashion and stuff like that. On the other hand, if you're looking at the sport the athletics part of it, it is really, you cannot really substitute it because you need the performance that the gear gives you.
So right now, they don't seem to have a lot of viable substitutes that are hurting this industry. Matter of fact, you could actually make an argument that this industry is the substitute that's benefited from the other industry, because look at how all of you are dressed. I mean, many of you are dressed like you're, just got out of bed or just got back from the gym, right? And I'm not going to call that an indictment. I'm going to say that that's how society has changed. And that's now perfectly acceptable. Even work attire is to go very business casual. And that, I think, has helped this industry. So even other types of clothing, it's not had been a threat, because to some degree, this has been where the puck has been going. And it's been very, very favorable. And you can see it, that unless you individually screw up like Under Armour did, that it's relatively easy to make money in this industry. Okay, get good returns. And the forces are, for the most part, pretty favorable. But this is the $1 million question. Is that going to change in 5 years? Because what we're trying to understand eventually is this industry going to have a spread where you're making high 30s for operating ROIC? Or is that operating ROIC, which should trend towards the mean over time according to the book, is that going to change? And so instead of forecasting the number, we're going to forecast the change in the forces, if any. So in 5 years, would any of those forces change? What did you guys say?
In terms of, I'm sorry.
Sorry, and if so, by the way, how does it impact the spread? So would they change? How does it impact the spread?
I said consumer spending is forecasted to decrease over the next couple of years. And just with everything going on with the economy now, I said that I think that the spread may decrease over the next couple of years, especially just because of consumer spending going down and their beta being so correlated with the market. That's what I put in my analysis.
If consumer spending goes down, which of the 5 forces does it change?
Buyer power, right?
So basically, it gives more power to the buyers because
they'll be more price sensitive to their products.
Great. So I'm just saying, I want you in the context of this assignment and future assignments to put in the context of the forces, just so we're using common language here. So I don't disagree with you, just make sure we link it back. All right, so that could be an argument that says the spread should go down a little bit. Now, let's assume that was the only change. Do you think the spread's going to go to 0 or negative because of that?
No.
Okay, so that's the other part, is magnitude. How much magnitude is this going to shift this directionally? A little bit? So not that much?
So my answer is slightly different for this. I thought for the short term, yes, because of all the economic factors and all that, you could see a reduced spread. But I thought long term, the competitive advantage will remain, and the spread would probably remain the same or go up.
So what you're saying is, but if you're saying, let's start with the spread. If you think the industry is going to be still very attractive around this level of spread, you're saying long-term, those forces aren't going to fundamentally change.
That's what I thought.
Okay.
At least reading all the articles you've posted and all the technology these companies are investing in, I thought.
Well, again, that is a potentially reasonable scenario. And I can't say, by the way, that either one of you are incorrect, because we're now talking about the future. So for purposes of your assignments, by the way, what's going to be helpful is if you back it up with something that's reasonable data. Meaning, I think this, and by the way, I'm sourcing IBIS, or I'm sourcing some industry research or something that suggests that it's still a long-term secular growth trend. This is just a speed bump. And therefore, it will go back to that longer-term trend, and we don't see the forces changing. Or no, something fundamentals can start to change in this industry over time, that the buyers are actually going to start becoming much more price sensitive, and they're going to care less about that. And that's a fundamental change in the way this industry is going to be. And so that would give you a different scenario to say, no, suddenly that relationship is actually going to start driving that operating ROIC down. Okay. So I just want to have some data to support that, like what would support that. and not too much data, but just generally follow through your assumptions. Well, how about other people on this call? I can start just randomly calling on people, but how about some other people who haven't talked yet?
So I added something in on top of what everybody else was saying as far as some of the higher tariffs and things that we've been imposing on countries like China. And I think, I forget which articles kept saying that they were sort of consolidating the market, that some of these other competitors are going to end up dropping out, I think, because of that.
Okay, so that would be beneficial to the industry?
I thought it was not beneficial for the
Okay.
industry. I thought it would be another barrier to entry.
Okay. And so therefore, what would happen to the spread as a result of that?
I think the spread would decrease then. There'd be fewer, I think, fewer companies in a higher competition.
So let's fast forward 5 weeks, assuming the world doesn't end by that time. Basically, if Nike was your group project, and what he just said is part of the EIC part of your presentation for the group project, then that's going to need to be reflected in your valuation. Okay, because these parts of these projects help each other, and they should be a puzzle piece that starts to connect, right? Because if your view of the world is as he defined, and that starts to change what the industry looks over time, then I'm going to forecast different growth rates. I'm going to forecast different margins. I'm going to forecast different levels of investment when we get to our cash flow valuation. And then we're going to try and model what we think these mean. So when I start asking about directions, like this isn't just an academic exercise, because this is going to help inform us when we start to actually quantify what this would mean for the company later. Okay, so that's why it's just, even if you start thinking about directions of numbers, oh, well, this means eventually sales growth is going to be a little bit lower. So if Nike is growing, EEO this for a second. If Nike is, their revenue growth rate is 6, 8, 8, 7 right now by Wall Street, and you have that scenario of tougher 5 forces, then maybe these growth rates start looking more like 7 to 5 as opposed to 8 to 7. Okay, and that's the type of thing that we're going to start to quantify over the next several weeks, and that's part of what we're trying to do with the EIC. Okay, just a preview on that one. So in the interest of time, let's go to the C. What about competitive advantage? We said Nike does demonstrate competitive advantage. What about Nike, now we're not interested in Nike, gives them competitive advantage? Why is Nike so good?
One of the main reasons that Nike is so good is because of that brand image that it has. It's able to curate all these athletes that it can sign for its brand, like LeBron James and Michael Jordan, stuff like that, which other brands can't do now because they've locked them in for lifetime deals. And these fans have, or these players have large fan followings, so they bring in those customers as well into that market. So it kind of really helps them establish that competitive advantage there.
Yeah, yeah, because that's the point here. What the competitive advantage is trying to explain is that's why they have that positive spread. And again, very, very valuable, not only for the industry, but Nike in particular does it better than everybody else, is what I heard you just say. So that's one reason. What else gives Nike competitive advantage? Or is that it? As the group think about the answers that you guys gave for them.
I know we talked
about
about
they had a competitive advantage just because I think their market cap was like 105 billion. It was just such a large amount of the entire market that gives you a lot of muscle, so you can really throw your weight around a lot further than the others.
So I'll use this different word: economy of scale. They have an economy of scale, and by the way, they also have that kind of size effect where, just like Walmart, has a leveraging power in the relative relationships. They can use their size and to leverage their power. So that to some degree could be benefiting them. Anything else contributing their competitive advantage based on what you read?
I said Nike had a competitive advantage because of innovation. So for example, they, I think, were the first movers into kind of the digital space. So with their digital applications.
Yeah, and they're very willing to experiment on, you know, digital clothing, et cetera, as you mentioned. So that definitely probably is also an advantage because of their size. All right, so here's the other final question. We'll kind of move on, but any of that going to change in 5 years? Because my final question is said a different way. Is that relative spread to the peers going to stay positive 5 years from now? But they are the things that allow them to be better than their peers basically going to be about the same, better, a little worse?
I think the threat of new entrants will get a little bit worse. I mean, when you watch TV, there's always a new commercial for new leggings, new sportswear that's coming out. And I think it's easier to advertise in the social media digital age and also to sell your products online. So it's just easier because you don't have to get into those big box retail stores that you were saying it's hard to get into. So I think there will be new entrants. They may not get the same scale, but that'll definitely change.
All right. Well, as you answer the last general two questions we've been asking for the last 10 or so minutes, which is what happens in this industry over time? What happens to competitive advantage over the time? Let me make sure that I address your bias and what the data says. So this is a chart that you should have burned into your brain from the book beyond this class. And what this said was that if you broke essentially the global 1000 into quintiles and you did a buy and hold strategy based on their ROIC, you saw a regression towards the mean, right? And by the way, if you did it with growth and you took the fastest growing companies versus slowest growing companies, as opposed to the highest ROIC companies versus the lowest ROIC by quintile, that you also saw regression to the mean, except it happened much faster, right? Growth slows down much faster because of nothing else, the law of large number effect. We talked about that last week, right? But ultimately, Nike, just like everybody else, is facing this, right? And the more recent version of why they're facing this goes back to what I started to mention last week, that competitive advantage is transient because it's more about the waves than the moats, okay? Because a lot of the Wall Street bias historically has been moats, which is Nike has this advantage, they're going to keep this advantage for a very long time, and so their returns will never go down. When the reality is, very few companies can maintain their competitive advantage long term, right? Because tastes change, market moves on, competitors adapt, whatever, and that's where the wave theory comes in. And the wave theory, to some degree, builds on this. Our bias should be, it's not going to last. So back to, it's not just does Nike have advantage, but we have to recognize how long are they going to maintain those advantages. And we tend to think that they last very, very long term. And in today's world, it's getting shorter, right? And you could even see it with, you know, as I said, look at your grocery store. You know, 10 years ago, look at the food that was on the shelves. It was all the brands. And everybody said, oh no, the generics will never make it into the grocery stores. Now, 10 years later, it's the exact opposite. The grocery stores are making money on their own brands and their generics, much more so than the traditional brands, and the shelf space of those brands has gone down dramatically. And so I say that in the context of it's probably going to eventually happen in Nike. As good as they are, they're probably not going to be the dominant player in 15 or 20 years. Now, 5 years, maybe. But that's what we're trying to assess. And how long is it going to last? Nothing lasts forever. So that would be just the only other context I would have as you think about answering these questions. Now, could there be exceptions? Absolutely. But I challenge you to name a company that was number one to the degree that Nike was 30 years ago that is still today in whatever industry you pick. And you're going to have a hard time coming up with many of those people on that list. And it's not an indictment against those companies. It's just 30 years ago, we'd be talking about GE. You know, we're not doing that anymore. 20 years ago, we talked about Dell. Right? We're not talking about them anymore. You know, now the company is moving to Amazon. And I'll tell you, in 30 years, we're not going to be talking about Amazon. We'll be talking about somebody else. And it's not against Amazon's a great company. It's just that's the way the world works. So that needs to be our bias as we think about this. So again, not saying they don't have competitive advantage, and your answers are actually very helpful, but that's just the context that we need to have when we value them. Because otherwise what we'll do is we'll overvalue the company, because we'll just assume that they get too much growth and too much margin, too much return, longer than what the market really represents, and we'll just overshoot the valuation. Okay? Now the flip side is also true, meaning, and this is what we're going to struggle with right now, which is, I'll give you in a different example, like, is now a good time to buy JetBlue? I'll switch industries for a second. Here's a share price. This is 1 year. They were trading at $20 a share not too long ago. Today they're at $7. Now a good time to buy JetBlue.
If they survive it.
What happens if they survive?
It's going to bounce right back up.
So again, I think this is probably on the company news feed of Bloomberg, but what freaked them out was this, is that the CEO of JetBlue came out this morning and said, revenue this month is down 82%. And not only is it down 82%, but everybody's asking for refunds because nobody wants to fly on the stuff they bought last month, because everybody's just canceled their flights. So we're basically going from, I don't know if this is this version of the news story, but $4 million per day is what they're generating now in fees and bookings versus $22 million a day before the crisis. That's what's happened to their sales. And by the way, at $4 million a day, they're cash flow negative. So that's basically what caused the market to drop their stock. Okay. So I'm just saying, let's assume JetBlue makes it, because I assume that JetBlue is probably going to stay in business. It's probably one of the better airlines. Now a good time to buy them?
I mean, yes, at some point travel will return back to normal. It's just a matter of what that time horizon is. So if it's 6 months, a year from now, I mean, it will turn around if they survive it. Like, that's our assumption. So yes.
This is JetBlue. It's underperforming. And what the data says is these underperforming big companies actually start to improve their performance as a group. Right? Now, part of it is, and it's not just a survivor bias, but part of it is it's kind of adapt or die, that the poor performers get starved of capital and they actually start to improve over time only because they don't have a choice. But what I'm also saying is that when companies underperform, as long as you have a long-term business model that's viable, then you don't stay poor performing for very long periods of time. So that's the point. Scenario A, JetBlue doesn't make it. They go to zero, they're wiped out, the government doesn't bail them out. That is a probability we would have to take into account. But assuming that doesn't happen, probability number two says they go back towards 22 million a month, might take them a year or two, but back at 22 million a month in revenue, well, that's closer to $20 stock price. And their business model is going to be viable again. So, you know, if I can hold on with my roller coaster, then buying them now is not necessarily the worst thing to do. It's just going to look really frightening for the next 3 to 6 months. That's the buy and hold strategy. By the way, that's what the data says long term, that this is the Fidelity Contra Fund in motion. And one of the reasons why the Fidelity Contra Fund has made a lot of money over time is they just buy all the poor performers, because the idea is people have so much negative reaction that they assume the sky is falling. And yes, it looks like it is the short term, but they just lose sight that long term things go back to normal, and they shoot in both directions. Right? They overshoot on the high end, assuming things will always be rosy forever, and they overshoot in the low end, because some of these big companies will bounce back. Now, obviously there's exceptions, right? But regardless, that's what we'd have to figure out for JetBlue. But I'm just saying, if you don't think they're going to go bankrupt, now's a really good time to buy any one of those major airlines, and you're going to be very happy in 3 years. But there is a probability you could lose all your money. So this is an academic exercise, not a direct recommendation. I don't want you to come looking for me in 3 years saying I put my basically tuition money on JetBlue and lost it all. Right? That's not my recommendation. Not a financial advisor. Anyhow, all right, that was the IC. So very quickly, Costco. Here's Costco. RV. E. Economic sensitivity. What would we say about this group and about Costco pre-crisis?
The group's not affected as much by the economic changes.
Because?
The adjusted beta is 0.79 compared to the market's 1.
Yeah, and by the way, I want you to use raw to answer that question. So
okay.
And 0.86. So it shouldn't be a surprise that in today's market, Costco is probably doing relatively better than some of its peers. If for no other reason, then people are still shopping at some stores. That's one of the ones that is open that people are lining up to get into. All right, so there's your E. Is this, again, going historically, is this an attractive industry? And does Costco demonstrate competitive advantage? Sorry, this template. Is this an attractive industry? And does Costco demonstrate competitive advantage?
Yes, it's an attractive industry because the operating ROIC is greater than the WACC for the market weighted average. And yes, Costco has a competitive advantage because their spread is greater than the spread of the industry peers.
That's exactly the right answer, with the exception you'll still get a 0 on your assignment because I need you to use numbers.
Got it.
Your operating ROIC, everything says right. 13.36 against 7.13 makes it attractive. 22.35 minus 8.83 makes it more attractive. And just add those 2 other data points. But otherwise, this is exactly right. That's the way I want you to think about that. Okay? Try one more. Is this, here's Ford, an attractive industry? Actually, let's do E first. Markets, autos. Data. Economic sensitivity of these autos. Markets. Little mouse problems here. Apologize for that. There we go. Whoa, why'd that switch? Ford, markets, beta. Autos economically sensitive? Yes or no?
Yes.
Ford, less so because their beta is 0.85, right? Now, 0.85 doesn't mean it's not sensitive. It just means it goes down slower than the rest of the industry. All right. But this is where the rear view mirror could get us in trouble. Why do you think Ford's beta was generally lower than the rest of the industry? What protected Ford more historically in the automobile industry cycles? Why do you think they have a lower beta? What about Ford's business?
Isn't it protected from the chicken tax?
Potentially. But I think part of what helps Ford is what they sell. What is Ford's business? What do they sell?
Ford sells mainly trucks and large, trucks and that kind of stuff. So
what's been the trend in the U.S. market?
growing towards the larger vehicles, larger size vehicles.
Yeah, as a matter of fact, people aren't buying sedans. They're not buying small cars. They're buying SUVs, they're buying crossovers, they're buying trucks. It's all Ford sells. So one could actually make an argument that Ford's beta was a little bit lower and less sensitive because for the last period of sustained growth, Ford basically was winning just because of the trend that they were in. They were where the puck was going. Now, that may not explain what's happening to them right now, because right now people aren't buying any cars. And by the way, Ford's no different than everybody else. So the beta is actually misleading in that you think, oh, Ford's not going to be hit by this. Well, in the virus, everybody's hit. So the 0.85 just says they're probably less than the industry because of trucks. We got to think through what that means in today's environment. When auto sales were down today, I think 36% since the beginning of the month. They're going down by week. People aren't buying cars, which means they're also not buying trucks. Even though oil today, if you saw, hit $20 a barrel, you're going to see gas prices below $1, which I never thought I would see again in my lifetime. Yeah, $23.58 a barrel. You're probably in some of your states going to see gas go below $1. It's going to be like 99 cents for regular. But anyways, so get one benefit out of this virus. All right, EIC, questions, comments about anything? Can you repeat this? Great. So let's go back and pick teams. Hope you guys have been chatting along the way. So back to this. We got 3 companies to pick. And one of the sections on the companies is going to be doing an EIC analysis. And this is something you're going to present in week 7. So you guys can even get started sooner. Once you give the teams, I'm going to start putting some data about the companies you select into the file section. There'll be a folder in here, and the folder will be called teams or something like that. And then your team name based on the company you choose will be there. And I'll start putting some data there to help you from Bloomberg. Now, again, you're not limited to that. You can use other data sources, but regardless, I'll start putting some data on there from Bloomberg and IBIS about the companies that you chose. So let's go back to choosing people. Do we have an answer for your group 1, 2, and 3?
We'll do Peloton.
Which one? Group 3?
Yeah, group 3. Peloton.
Okay, so group 3. Edit. Hold on. Before you do, all right, I will warn you that they're going to be a little bit trickier to do the historical analysis because they don't have a lot of history, right? It won't impede your ability to do evaluation, but I am warning you, it will make it a little trickier because they don't have much in the way of history. Because one of the analysis we're going to do next week says, look at the last 5 years, and you don't have 5 years worth of data. You have 3 years worth of data. And I'll still let you do a 3-year analysis, but nonetheless, that will make Peloton slightly more challenging just because they're so new. But I'll still let you do them. So
Do we have the option to change if we?
I would just say change within a week, by
Okay.
next week.
All right.
Because again, unfortunately, we're not going to get to the valuation and this historical analysis. Like you're going to start doing historical analysis next week, and then that historical analysis and doing the company analysis from that, you'll have the ability to do that after next week. So you kind of get a sense of what you're going to have to do for that analysis in this upcoming week, but you're going to play with their data probably the week thereafter. So, but regardless, we'll put that in here as a placeholder. So group 3, I'll call you still group 3, put a hyphen, Peloton. If nothing else, I think it's an interesting company because again, they're going up while all the gyms are going down. So interesting to look at. All right, group 1 and 2.
Group 1, HelloFresh, please.
Again, let's make sure.
Yeah, we might have the same issue.
HelloFresh is a German company. So that's going to add a little complexity because they're German. All right, it means you got to deal with euros and they're global. But see how much historical data they have. Now, the good news is they actually have 6 years worth of historical data. It just looks pretty fugly. But you got 3 years that they were private, 3 years they were public. So they've never made money. But regardless, doesn't mean you can't do it, but they're going to have a couple complications because they've always lost money and they're global. But I like that. I like messy. So I'm happy to let you do it. So HelloFresh. That's group 1 or 2?
Group 1.
Group 1, HelloFresh. All right. Group 2?
We'll do Tesla, please.
Oh, God. This class is just asking for the tough companies. All right. And I'm not saying the Tesla is any different because I'm actually going to be very curious what you guys have to say. And the reason why I'm curious is this. Tesla's share price since we last met last week was $700 a share, and today it's $361. So Tesla's seen their stock price go down 50% in a week. So this is going to be interesting to explain. But nonetheless, I'm curious to hear what you guys have to say. So these will be the 3 companies. As I said, as you guys work into this, and their share price was down $70 today. But these are the things we'll start to look at and hopefully try and explain. I'll be working on over the next several weeks. But if you're going to change, I'm going to have to start to lock you in because as we go through the rest of this shortened semester, you're just not going to have a time to redo all of the assignment. All right. So just in context, the final project in this class, which is a big chunk of your grade, which will be the last week of class, week 7, on Zoom, you'll be presenting to me 20 minutes each on these 3 companies. All right. And you'll do an EIC, which is about 5 minutes. You'll do a historical analysis, which is about 5 minutes. This is just following the assignments. You'll do a valuation, detailed spreadsheets with scenarios, bull, bear, target. And then you'll do a multiples analysis and an explanation about 5 minutes. Those are the assignments that are coming up in the next few weeks. And as you do these individual assignments, you'll then turn it on to Peloton, Tesla, and HelloFresh. Okay, so you'll be kind of like 1 week lagging was what I'd recommend, and waiting till the last weekend as you start working on these companies. Okay. All right. Last thing I want to mention for last week, then we'll let everybody go. Maybe a couple minutes early, unless you have any questions. Here, under the assignments for next week, we're going to get into historical analysis. Right? And so I'll just warn you that this is probably going to be the hardest thing you do this semester, right, is the historical analysis, because you're just not used to looking at company statements using this methodology, okay? So, and I say this in the videos, but the methodology for economic statement conversion is actually something that was developed the way we're doing it by the consulting firm McKinsey. And so they don't do this anywhere else around outside of Wharton and at McKinsey in this process that I'm going to put you guys through. You're going to hate this process because what McKinsey did is they mapped the accounting statements to Modigliani-Miller, okay? And so what we're going to do is we're going to take accounting statements and we're going to put them back into an economic basis mapped to Modigliani-Miller. And so that's something that you're going to have to kind of learn how to do. And that's what next week's assignment is going to be. So there's going to be 2 parts of next week's assignments. So the first part of next week's assignments is you're going to take an income statement and a balance sheet. That's the economic statement conversion in Excel. And in Excel, there's 4 economic statements. And you're going to rearrange into 4 new tabs that Excel file. So you'll start out with the historical data. In fact, I'll download and open this file. Let's try. You'll download and open this file with historical data, just a random company, income statement, balance sheet data, okay? And what you're gonna do is you're gonna create 4 new tabs. So in your model, you'll call it TFI. So name the tab, TFI. All right, and that is gonna be the rearranged balance sheet. Look there so you can see what I'm doing. So you'll have another tab, TII. You'll have a 3rd tab, CFI, and a 4th tab, economic profit, which is EP, right? Very important. You have to submit to me the same Excel file that you download. And this is an individual assignment. So all of you are going to have to download this file, create new tabs in this file, create the solution in this file, and then upload this file back to ELMS. That is the first half of week 3's homework assignment. And the 2 parts that are going to be tricky, and I spent a lot of time on this in the video, is number 1, you have to basically create the statements and get them to balance, all right? Because this is something that we do in this class, which is we say that in a lot of other classes, you might calculate free cash flow, but you stop at free cash flow. And we're not going to do that. We're going to balance free cash flow and say, if you generated a certain amount of cash, what'd you do with it? Because the 2 have to be equal. So if I generated $300 million of the cash, what did I do with the $300 million? That's what I mean by balancing. And so the statements are set up to balance so that there's a sort of there's an investment asset / income side, and there's a finance spending side. And the 2 are always going to equal each other. And that's going to be something you're not used to because you have to actually balance these statements. And so that's something I talk about how to do on the video, all right? And that's the other part, which is these statements are not GAAP, all right? So don't get too confused because they don't follow accounting rules because they're not set up to follow accounting rules. They're set up to talk about whether a company's generating cash flow or losing cash flow in an operating and a non-operating basis. And what did they do with it, right? So again, book covers this. Videos cover this. This is the first part of the assignment. And by the way, this is midterm 1. So coming up in a few weeks, there's 2 midterms. Even though they're actually near the end of the class, we're calling them midterms. The first of the midterms is a repeat of this assignment. So your first midterm is going to be, I'm going to give you financial statements that look like this, and you have to convert them. And that's midterm 1. So this is also a dry run for what you're going to have to do in a few weeks for the midterm. This is the first homework assignment. Once you convert these statements, there's 2 economic statements, which is part 2 of the assignment, which we're going to call historical analysis, right? And essentially, for the historical analysis, you're going to see a tree and you're going to see a cash flow statement that's converted. And so what you have to do is explain it, explain the changes, okay? Now, you don't have to create this tree and you don't have to create the cash flow analysis for this assignment. right? You're just going to analyze it. But it's based on the process that you did in the first half of the homework assignment. And when we build the valuation model will create statements like this for Peloton, Tesla, and HelloFresh. So the exact process that you're going through for this assignment, once you build the model will spit out the tree and the CFI that you will analyze. So just a preview of what's coming up in the context for this assignment. Again, as you get through the video and you start doing assignments, it should be more clear. I just wanted to mention that. All right. Back to questions, comments about anything. All right, then I will give everybody 9 minutes of their lives back on this Wednesday night. I will record this video. Again, I have a second class section that starts at 8:45. So I'm recording both sections right now. So your video will be up with your section at 7 p.m. Their video will be the ones labeled 8:45, in case you're just curious, because there's 2 videos per week. All right. So other than that, everybody have a great week. Stay safe, and I'll see you guys next Wednesday. Bye-bye.
All right, Professor?
Yes.
Could we change HelloFresh to Delta, please?
Sure. Delta Airlines?
Yes.
I think that that's actually going to be a much more straightforward company. So let me do that before I move. Even though I do appreciate the ambition. I don't want to see you guys really struggle.
We didn't realize it was going to be as ambitious as it was. We just thought it was an interesting company.
Well, as I said, I don't disagree with what you're doing. I'm just saying that in the process we're going to put you through for the class, you're going to have probably more challenges because you got to deal with the international currency issues as well as the fact that they don't have a lot of history.
Probably should start on the Black Diamond.
So exactly, you want to start on whatever the easy ski slope is. You don't go to
the bunny slope.
Yeah.
So Delta's probably, I wouldn't say Delta's easy, but it'll be a little bit easier.
All right.
All right,
Thank you.
guys are switched.
Thank you.
No problem.
Thank you.
Good night, everybody.
Good night.
Professor,
Yes.
I just had a quick question. I sent you an email last night. I've been working on the economic conversions, and I got the TFI, TII, and the EP no issues, and I knew the CFI was going to be a problem, and I spent a couple hours on it, and I was just curious if there were any other references that I could look at. I'm at this point.
Well, unfortunately, because the process is relatively McKinsey-like.
Yeah.
It's kind of like the book and what we do in the class. But I'll tell you what, do you have your spreadsheet with you?
Yeah, I have it right in front of me.
Can you share your desktop and pull it up? Or share it and pull it up? I can try and at least look at it and give you some suggestions.
Yeah, and I will, let me see. I will warn you that the CFI one probably is pretty ugly, only because I've been.
This is not an uncommon issue. This is not an easy, that's the statement everybody has trouble with. And by the way, even in the real world, if you're starting from scratch, this is hard to do.
Yeah. Okay. So it says I don't have the security preferences set up for Zoom to share my screen. It's going to force me to quit and then.
Can you email it to me?
Yeah, I can email it to you. I mean, I can do that.
Email me the spreadsheet.
Okay.
And what I can do is I can take a look at it and then just make some suggestions back in the email about what I see missing.
Yeah, that'd be great, because I think at this point I was going through the book and I was I think I'm exhausting kind of all my options, and it devolved to the level where I was all right, I'm just changing numbers to see if I can get it, which I know is never going to get me the right answer.
Like I said, send me the spreadsheet.
Okay.
I don't know if I'll get it before the next class, but I'll send you back an email with some feedback on what I think will give you some suggestions to put you back on the right track.
Okay, I appreciate it. Thank you.
Oh, no problem. Have a good one.
You too.
All right, bye-bye.
Bye.